Okay, I'm back. All right. So as I was saying, not every information will enter the statement of financial position, cash flow, equity, and also the statement of profit or loss. So due to that, the IAS standard also provides that we publish a note. So that will talk about other information that are not included in the statement of financial position, cash flow, and other statements. So it is very written. So some of the items we can find in is the accounting policy used, some of the legal laws. So for instance, if you are applying for company, so the Companies Act could be written in it, and also certain vital standards, and also accounting policies, depreciation, all those stuff could also feature. All right. Okay. So I have the first question on presentation of financial statement. That's MBAF 601 financial reporting on Berlin Limited. I would like to know whether you have already tackled that. Can I get some response?
Friends, no.
Okay. All right. Okay. So
Okay.
I think that would be our first discussion, our first question solving. Is that okay? So I don't know if all of you can locate that file, or I should put it on the page now.
Please put it on the page, man.
All right. Okay, so I have sent a copy on the WhatsApp platform, so you can download it and then we look through. All right, I hope you can all see my screen. Okay, so the first question is about Berlin Limited, a statement as at 30th September 2021. Right, and then every financial statement is accompanied by an additional information. So the additional information must be adjusted, yes, to help us in preparing the statement which we've been required of. So A, we are required to prepare a statement of profit or loss and other comprehensive income for the year ended 30th September 2021. and also prepare statements of changes in equity, and also prepare statements of financial position. So our financial position will tell us whether whatever we did is right or wrong, because that is a balancing account. It's a self-balancing account. So whatever we do, the adjustments we do will tell us whether we've done the right thing or not. And also, every additional information will call for a review of what the standard is saying, because we are not doing everything according to our description. Everything we will do regarding a transaction has been spelled out in the standard. So if it requires the visitation of the standard, we will do that. Alright. So let me read out the additional information, and then later we tackle it one after the other. So the first additional information, Berlin Limited's revenue includes 24,000 for goods sold to Galamsey Limited on 1st October 2021 on a 30-day right of return basis. Berlin Limited normally makes a gross profit of 25%. Berlin is uncertain as to whether any of these goods will be returned within the 30-day period. 2. Administrative expenses include an equity dividend of 36,000 paid during the year. 3. The 5% convertible loan note was issued for proceeds of 60,000 on 1st October 2020. It has an effective interest rate of 8% due to the value of its conversion option. 4. The balance on current tax presents the under...
Hello?
Yeah.
Hello?
Yes.
Yeah, sorry, please, moderator, my network was messing up.
Okay.
Have you started with the calculation?
No, we haven't started. We are reading the question.
Okay.
Hello, Prince.
Yes, I'm listening.
Please kindly engage us, okay?
Okay.
Like some of the questions, let us read.
Okay.
And okay.
Okay. All right. Thank you very much. Okay. All right. So let me finish with it. All right. So the balance on the current tax presents the under and over provision of the tax liability for the year ended 30th September 2020. The directors have estimated the provision for income tax for the year ended 30th September 2018 at 48,600. At 30th September 2021, the current amount of Berlin Limited's net assets were 39,000 in excess of their tax base. The income tax rate of Berlin is 30%. So the last one, the non-current asset. Okay. So the freehold property has a land element of 39,000. The building element is being depreciated on a straight line basis. Plant and equipment is depreciated at 40% per annum using the reducing balance method. Berlin Limited's brand in the trial balance relates to a product line that is received bad publicity during the year, which led to falling sales revenue. An impairment review was conducted on 1st April 2021, which concluded that, based on estimated future sales, the brand had a value in use of 36,000 and a remaining life of only 3 years. However, on the same date as the impairment review, Berlin Limited received an offer to purchase the brand for 45,000. Prior to the impairment review, it was being depreciated using the straight line method over a 10-year life. No depreciation or amortization has yet been charged on any non-current asset for the year ended 30th September 2022. Depreciation, amortization, and impairment charges are all charged to cost of sales. Alright. Okay, so this is the statement we'll be working with. Alright, so the first additional information. So we'll tackle each additional information, we'll explain it, and then if there is an error, we treat the error, and then we adjust our statement. So we will start with us to take us through, read out the first additional information, so we tackle it. If no one wants, I'll mention anyone's name to do that. So someone should voluntarily start. Okay, so can we have Madam Millicent start with us? The additional information 1. Could you please read out to us?
Berlin Limited revenue includes 24,000 Ghana cedis for goods sold to Galamsey Limited on 1st October 2021 on a 30 days right of return basis.
Okay.
Shall I continue?
Yes, can you continue?
Berlin Limited normally makes a gross profit of 25%. Berlin is uncertain as to whether any of these goods will be returned within the 30 days period.
Okay, so what standard is this transaction relating to? Who can tell us the standard? Ability to
inventory IAS 2 or
okay, so inventory IAS 2. Any other standard? I heard inventory. So which other standard can we attribute this transaction to apart from inventory? Okay, so the first standard, yes, is obvious, inventory. So the next standard we can talk of is revenue. Is that okay? Revenue, IFRS 15. Okay, so that is the head standard, and also we will say inventory will be a subordinating standard because we have inventory being sold, and then the resultant will be a revenue. Right. So the statement has 24,000 included in the revenue, in the total revenue. So we have 24,000 included in the revenue. 24,000. And then we were told that this transaction which Berlin Limited had with Galamsey Limited has a 30-day right of return basis, and we all understand right of return basis. So it means that it's like a guarantee or warranty. Yes, I don't know which relates to this, but you have the right to return the item within 30 days. Is that okay? And if you are reflecting on IFRS 15, IFRS 15 deals with revenue recognition, and then the last part of the processes in analyzing when a revenue should be recognized, the last one says that performance obligation must be fully performed. So which means that there shouldn't be any uncertainty regarding whether or not performance obligation has been performed or satisfied. But in this transaction, we were told that Berlin has recognized the 24,000 revenue regarding goods sold to Galamsey Limited. But the condition is that Galamsey Limited can return the item within 30 days. So it results in us understanding that the total 24,000 could be excluded in our statement if only Galamsey returns the item. And here lies the case: Berlin Limited is not sure whether the item will be retained, which means there is uncertainty. As they've already told us, there is uncertainty regarding the return of the item within the 30 days. So which means that Berlin Limited has the right to fully recognize the revenue after 30 days. After 30 days, anyone who returns the goods will not be refunded their money. So which means that within that 30 days, Berlin Limited has an obligation. So the right word to use is that, an obligation. So Galamsey has the right, and then Berlin has the obligation. And wherever obligation arises, there is a liability. So let's get it straight. Galamsey has the right within that 30 days. Berlin has an obligation to provide or refund their money, the money to Galamsey. So the right thing to do by Berlin is to fully record the revenue after the 30 days. But now, the money has already been received. The money has already been received. Okay. So the right treatment for this transaction is to exclude the 24,000 from the total revenue, of this. So we have 1,140,000. Is that okay? All right. So we can okay. Yes, so I wanted us to have a brighter view. Okay, so we have the revenue, and then the revenue is 1,140,000. 1,140,000. Yeah, okay. Right.
Hi, please, can you zoom in a little?
Okay. I'll do that. Okay. I hope it's visible now.
Yeah.
Okay.
Thank you.
All right. So we have this, and then all right, and then the deferred. So we term it as a deferred income. So an income which is deferred income. So deferred income of 24,000. So 24,000. So the actual revenue is going to be, so this minus this will give us the actual revenue. So this will be the revenue which we are going to recognize. So the effect of this is that if you want to pass a double entry, the double entry will be to debit your revenue by reducing the figure and then crediting deferred income. So deferred income here will be a liability. It will be a liability to the entity because you are holding an amount of money which the person will come for. So here the substance over form comes in. You are holding an amount of money, 24,000. In actual fact, in terms of legal form, you've sold the item. But in substance, the person has the right to come for the money. So it will be a liability. So we will recognize it as a liability in our statement within this period. So that's the first transaction. So that is how we tackle the first transaction. So let's look at the next transaction. So the next transaction, can we have someone go to that?
Okay, administrative expenses include an equity dividend of 36,000 Ghana cedis paid during the year.
Okay, so who can tell us what's happening here and what should we do or what can we do? Can someone try that for us?
Please, can you share the screen of the question?
Okay, that's what I'm sharing. I don't know if you don't have it. If it's not showing, then I guess it's your network. Is it showing?
No, not sure.
I have it showing here. Is there anyone experiencing the same problem?
No, it's showing
Yeah,
here.
it's showing. It's showing here.
Yeah.
Okay, so the II, yes, we can tell us what we can do, and I've also shared it on the page, so you can open that. So administrative expenses include an equity dividend of 36,000 paid during the year. So this is the administrative expense. So this is our administrative expense, right? So we have it here. So this amount has a dividend, equity dividend of 36,000 paid during the year. Okay, and then so let's break this down. Administrative expenses are items that will be included in the statement of profit or loss. So which means that any item that is not supposed to be in the profit or loss must not be included in the administrative expense. And equity dividend is a component that must be under changes in equity. Is that okay? Under changes in equity. So we have to exclude that amount from it. Okay, so in treating this also we have to do something here. So we have our admin expenses. We have our admin expenses, and then our admin expense is 151,500. Is that okay? And then we have the equity dividend. The equity dividend, which is 36,000. So 36,000. So we need to exclude it. Is that okay? So we have this. So this will be the actual admin expense. I hope it's simple. Alright, so this will be the actual admin expense. Alright. Okay. Can we move on? Okay. So let's take note of each transaction we are adjusting. Is that okay? Alright. Now the next thing. So the third one, someone should read for us.
The 5% convertible loan note was issued for proceeds of 60,000 Ghana cedis on 1st October 2020. It has an effective interest rate of 8% due to the value of its conversion option.
Okay. All right. Thank you very much. So which standard can we attribute this transaction to? The standard should
IAS, is it 36? No, 38.
IAS 38.
38.
Okay.
Intangible assets. Oh,
Okay, that's your opinion. So, is there any other? Thank you very much for that. Hmm. Who else? Hmm. Convertible loan notes was issued for proceed of 60,000. So, if we are able to link the transaction to the standard, it will help us in identifying what the transaction is requiring from us. Okay. Yes. Okay. So the standard that deals with this transaction will be IFRS 9. Is that okay? Financial instrument. Is it clear?
Oh, okay.
Yes, financial instrument. So convertible loan notes is a financial instrument. It's a financial instrument. Okay, and then it was issued. So it being issued, Berlin Limited is the one issuing it. So it will be a financial liability. Okay, and it was issued for a proceed of 60,000. Then the date is on 1st October 2020. So which means at the start of the year. Then the effective interest rate is 8%. Then the coupon is 5%. The coupon is 5%. All right. Okay. So let's go through what the standard IFRS 9 says when you have a convertible loan note. So the standard says that when you have a convertible loan note, you split them into a financial liability and equity. So what convertible loan note talks about is that you have issued loan notes to investors, and then you are telling the investor that on the day of maturity of the loan note, they have an option to convert their loan note into shares. So instead of them being credited formally, now they have the right to become shareholders. So they will convert a portion of the loan into equity. So they have two options: either to redeem the full loan or convert their loan into equity. Hence, they become shareholders. So that's the benefit of convertible loan note. So you have the right. So the right is at your own discretion, whether to redeem the loan or to convert it into shares. So you become a shareholder. I hope it's very understood. Okay, so
Yes.
all right, thank you. So anytime you see convertible loan, convertible bond, there is something you have to do. So what you have to do is the split accounting. So you may have to jot that down. The split accounting. So whenever you meet a convertible loan note, what must come in mind is split accounting. So the split accounting is that the loan note has a component of a liability and then equity. So since it has both elements, you have to split it. Okay. So now the standard says that the liability component is the present value of future cash flows. All right. And then when you take a financial instrument, the 5% convertible loan, so the 5% signifies the cash payment or the contractual cash flow, whether inflow or outflow. And now since Berlin Limited is the one who issued it, the 5% cash will be a cash payment to the investor. You'll be paying the investor 5% every year until the end of the loan. Is that okay? And then in this question, there wasn't much information regarding the convertible loan note, but there is this that makes it quite simpler. So this is what we have here. So loan note 2023, so which means that the maturity period is for 3 years. So from 2020, so 2021, 2022, 2023. So there will be cash payment of 3 years. Is that okay? So now let's go to our Excel sheet. So let's picture this portion, and then let's go to our Excel sheet. So we may have to jot it down. So the coupon rate is 5%. That will be the contractual cash flow on the face value of the convertible loan note. And then we will have the effective interest rate, which is 8%. Okay. All right. So the standard says that the financial liability will be the present value of the future cash flow, including the redemption amount of the convertible loan. So let's look at the practical aspect. That will make it very simple. So we have the convertible loan note. So convertible loan note is okay. So the first thing we have to do is that we need to look at our cash flow. So we have here, let me put in okay. So we'll have our cash flow. Then we'll have our discounting factor, our discount. Is that okay? All right. So the coupon or the cash flow will be 5% of 60,000. Okay. So the value of the convertible loan note is 60,000. So that's the face value of the convertible loan note. That will be 60,000. And then the coupon will be 5% of this. So so 5% of this, so that's of this. So we have 3,000. So okay. So we have 3,000. Then we have another 3,000. So for 3 years. Yeah. So this will be year 1, this will be year 2, and then this will be year 3. And then year 3, that is when we will redeem the convertible loan. So the standard says that the present value of the contractual cash flow and also the redemption amount. So on the last year, which is year 3, we will pay the year 3 contractual cash flow and then pay out the loan. Okay, so that's the assumption of the standard. So the standard says that the financial liability should be the present value of the coupon rates. That's the 3 years. And then the 3rd year, you should add the coupon. You should add the face value of the loan note to the 3rd year's cash flow, and then you discount or add it, and that will be your financial liability. So I don't know whether you are familiar with this treatment when you were doing financial instrument. So that is how it's going to be done. Okay, so let me put in another. Let me set another. Okay, So we have here a year. So we have here year 1, year 2, year 3, and then let me put here another year 3 again, and here we put in our 60,000. Okay, so that will be the cash flow. All right, so the discounting factor, according to the standard, we pick the higher of the coupon, and then the effective interest rate. So since the effective interest rate is higher than the coupon, we pick the effective interest rate, which is 8%. Is that okay? So discounting rate will be just the normal formula for present value factor. So that will be 1 over 1 plus the rate raised to the power the number of years. So the year 1 is going to be into brackets 1 divided by 1.08, then we close brackets, and then year 2 is going to be 1. So we have 1 over 1.08 raised to the power 2. So raised to the power 2, that will be year 2. And then we have year 3 will give us 1 over 1.08 raised to the power 3. And then year 3 will have the same, since it's just the same, so both of the coupon and then the face value will be the same. So we will have into bracket 1 over 1.08 raised to the power 3. Is that okay? Alright, so when we are done, so you multiply it by the cash flows. Is that okay? So when you find the present value factor of this, so you should just put it in 3 decimal places. Is that okay? So if you put it in 3 decimal places and you have a calculator with you, you should get 0.926. So that's 1 over 1.08 should give you 0.926. That's for year 1. And then year 2, 1 over 1.08 raised to the power 2 should give you 0.857. So if you have the present value table, you can also check it. So the first year should give you, the present value should give you 2778. Then the next year should give you 2571. The following year, that's the third year, should give you 238.
Hello, friends.
Yes, I'm listening.
Please, I hope you are recording.
Yes, I'm recording.
Okay.
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 Okay. So the third year will give us 2382. 2382. And then the last year, which is the third year, because that year will be the redemption. So we'll have 47,640. Okay. All right. So this will be the present value of the cash flow. Okay, the present value of the cash flow. All right. So the standard says that the summation of all these should give us our financial liability. That's what the standard is saying, that we should always split. If you have a convertible loan note, we should split it. All right. So we will term it as our financial liability. So we can have it here. Financial liability. All right. So okay. All right. So that will be our financial liability, and then the difference the difference between this and then the face value should give us the equity component. Okay, so let me put it here. So let me put it here underline, and then put here double underline. All right, so double underline. So here is where we have the 60,000. So here is where we have the 60,000. All right. Okay. So we have the 60,000. So the difference between the two should give us the equity component. Should give us the equity component of the instrument. So this minus this should give us. So now let's understand what we have done now. What we have done. I know it's quite technical. Yes. So let's go back to our question. So the question says that we have a 5% convertible loan note which was issued for 60,000. So this is the face value of the loan note, and then we will be paying 5% on this for 3 years, and then the loan will grow 8%. So that's the effective interest rate. The rate at which the loan will grow if the person if we had not issued it. Is that okay? All right. So the 5% was calculated on the face value, which is 60,000. All right. So that will be our cash flow. And then the standard says that if you have a convertible loan note, you should split it into financial liability and then equity. You should split it between the equity component and then the liability component. Right. So that is what we just did. So you need to estimate the cash flows that are within, and then you discount it. You discount it into their present, and then the difference of the present value and then the face value of the liability will be your equity. So that is it. So when you are done, this item will go into your financial position. Financial position. Yeah, okay. So to go into your financial position. All right. So both will go into your financial position, but this is going straight forward without any adjustment. So we'll add it to equity. But this one will need further adjustments. So we call that amortization. I hope we are on the same page. Any questions so far? Any questions so far?
No.
No question. Is everything clear? So I want us to come again.
Yeah.
Okay.
But if only you can summarize everything, just the convertible loan.
Okay. All right. Okay. Thank you very much. Okay. So convertible loan notes are loan notes that gives the holder two options. So the two options are, at the end of the loan note maturity, say at the end of 5 years, if I'm a holder of a loan note, I have the right to go for my cash of 60,000, or I will convert that cash of 60,000 into equity so that I'll be a shareholder. So that is it. So within the 5 years with which the loan note was issued to me and then I bought it, I was a creditor to the company within that 5-year period, or within the period with which the loan note was issued. So I was a creditor to them. But on the date of redemption, I can decide to go for a cash of 60,000, or the company will convert my 60,000 money, which they would have to give me, into shares, so that I will be a shareholder. So the IFRS standard, IFRS 9, is saying that the moment such transactions appear, the best thing to do is to estimate the future cash flows and then bring it into the present. The present value of the future cash flow should be the liability component of the instrument. And then the difference between the financial liability and the face value of the instrument should be your equity. Is that okay? All right. So when you are done, the equity component will add up to your equity, but your financial liability would need further adjustments. So which means that the equity component, we are done. So this item is going straight to equity, but the financial liability would need further adjustment called amortization. I hope we are familiar with IFRS 9. Are we?
Please, for me, I'm not.
Okay, but have you treated it in your course of lessons? Not previous, but just as you guys started the semester, have you treated financial instruments?
Yeah.
The lecturer. He or she did
so
that.
yes.
Okay, so I need a response so that I'll know how to whether to
Oh.
go more detailed or shallow, or I won't touch
Yeah.
certain things.
Yes, yeah, you did, but you can still go over.
Okay. All right. I just want to know whether some of my words will not be so foreign, so strange. That's why I'm asking. Okay. All right. So I hope we are all familiar with amortization. We know what we mean by amortization. Amortization schedule. I hope we are all aware of it.
Yeah.
All right. Okay. 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 So now let's move on. So the next thing is to amortize the financial liability. Is that okay? So we will have here our amortization schedule. So amortization schedule. So our amortization schedule. So the amortization schedule. So the first one would be our financial liability, the opening balance. Is that okay? So we'll have the opening balance, and then we'll have the effective interest rate. So the effective interest rate of 8%, and then we'll have the cash out. So let's say cash out, because that's what we'll be paying to the investor. So cash out of 5%, and then we'll have the closing balance. Is that okay? So we have the closing balance. All right. So the opening would be this amount. Is that okay? So that would be our 55,371. All right. So 55,371. So 55,371. Okay, and then the effective interest rate. So the effective interest rate will be 8% on this value. All right. So 8% on this value. So 8%. So that's 8% on this value. So 8% times this. So we have 4430. Okay, so that's a rounded one, and then we will have the coupon. So the coupon, we already know it, so which is 3,000, all right? But that will be a minus, all right? That will be a deduction, okay? That will be a deduction. That will be a deduction, okay? All right, because it's cash out. And then, so our closing balance should be the summation of all this. So we add this. Okay. All right. So now let's explain this. So now we've amortized the loan for 1 year because it started from 2020 and we are reporting at 2021. So it's just 1 year. Is that okay? So this will be our loan interest. Is that okay? So a loan interest of 4,430, and this will be the cash payment of 3,000. Is that okay? And then this amount will be our closing balance. This will be our closing balance, which will go to statement of financial position. Is that okay? And then this amount will go to profit or loss. Is that okay? All right. So having done that, now let's go to the question. Okay, so we were told that this is I. So let's see what relates to I. So we have I here as loan interest. So let's see. So the loan interest they reported was rather the 3,000. Okay, but in actual sense, it means that the entity didn't recognize or appreciate what the IFRS 9 standard is saying regarding convertible loan notes. So they didn't split it and then amortize the financial liability. So if we have done it, which means that this amount should have been the actual loan interest. Is that okay? But they reported only. So the loan interest reported was what? 3,000. Okay. So which means that we need to add up. So we need to add up the difference. Okay. So we should have reported 4,430, but they reported only 3,000. Okay. So since they reported only 3,000, we need to now put in the excess. All right, so the excess will be this and then minus this. Okay, all right, so which means that we will be adding this up to this. We will add this up to this, and then we'll get the actual loan interest. So actual loan interest. So actual loan interest. So that will be some summation of this and this. Right. So we'll get the actual one. I hope it's very simple. So after you have amortized it, the effective interest is, which is the interest that will go to profit or loss. You go to your statement to check whether everything is okay. So when we check, the interest they recorded was 3,000. So we need to what? Gross it up. So in grossing it up, we will add an excess of what? 1,430. Can we move on? All right. Okay.
Yeah, hello, Prince.
Yes.
So does it mean that in the income statement, are we going to recognize the 1,430 or the 4,430?
Okay, excellent. So now that we have adjusted and known the actual loan interest, which is 4,430, but there has already been they've already recorded 3,000 as loan interest. So we just add this to this, we get this. So this will be the actual loan interest we'll be charging against our profit or loss. So instead of reporting 3,000 as given here, we will now write 4,430. That's
Okay.
the difference. But
Okay.
mathematically, there has been an appreciation of the value of what? 1,430. I hope that makes sense.
Yeah.
Very good. All right. So can we move on?
And
Okay.
I think Millicent has raised her hand too.
Okay, sorry. Because I'm presenting, I'm not able to locate who is raising their hand. Okay, so can I please hear from you?
Okay, Prince, thank you. Please, after calculating the interest loan,
Okay.
by comparing what we did in the amortization schedule
Okay.
for us to arrive at the difference of 1430,
Okay.
you comparing that to the amount in the trial balance, are there cases where it happens to be more for us to
Okay.
less it
Yes.
from the loan
Very good.
interest?
Very good. Yes. Yes. So there are several cases where the interest that has been charged will be less. So
Okay.
after preparing the actual amortization schedule, we find the difference, and so in case that part is more, so let's assume a figure of say 5,000. 5,000. So let's assume it's 5,000. So if it is 5,000, which means there would be a difference of this minus the actual, which is this. So there will be a difference of what? 570. So if already in our statement we have 5,000 as the loan interest, we need to less 570 for it to now agree with the 4430. So which means that there are cases where the interest charge will be higher than the actual. So that one will require netting or lessen. And then the opposite is true, where it's also less with gross up. I hope that's simple.
Okay.
Thank you very much. Can we move on now? Okay. So let's move on to the next transaction. So the next transaction. Okay. So can we have some? I've not heard some of us voice. So if Nanaya Bonsu is there, I don't know. Yeah. So not Madam Nanaya, can you read that? Read the fourth additional information. Okay, can Madam Sheila do that?
Anaya. Nana.
What about Madam
Yeah,
Sheila?
some of them are having network challenge.
Okay,
So
okay.
let me read.
Okay.
The balance on current tax represents the under or over provision of the tax liability for the year ended 30th September 2020. The directors have estimated a provision for income tax for the year ended 30th September 2018 at 48,600. At 30th September 2021, the carrying amount of Berlin Limited net assets were 39,000 in excess of their tax base. The income tax rate of Berlin Limited is 30%.
Okay. Thank you very much. All right. So with this question, they were trying to adjust the years to suit this current year, but I think they missed out with the income tax estimate. So it should have been 2021, right? But they didn't. They couldn't do that. Okay. So let's start with the first aspect. So the first aspect is the under and over provision. So I'm sure all of us know this. Before before we file a tax return to Ghana Revenue Authority, we may have already estimated an amount for our financial statement's sake, because GRA will take long in processing our tax return before we know the actual tax we are paying. So as a company, we estimate a particular amount of tax and then we charge it against our statement of our statements, our financial statement, so that the actual tax when paid will check whether there's been a difference or not. So due to such estimations, there could be under or over provision. So the first sentence of IV says that the balance on current tax represents the under or over provision of tax liability for the year ended 30th September 2020. So now let's note this, whether or not we will know whether it is under or over provision. So it tells the position of the item. So the current tax, which is at the debit side, so it's at the debit side, all right? So the debit side. So since it's at the debit side, it will be an under provision. Is that okay? So it's going to be an under provision. So a current tax. So if there is an under tax provision, it will be a debit. So which means that instead of us estimating for 15,000, we estimated 12,000. So we underestimated, but we paid 15,000. So that is the assumption behind it. So there is under provision when we provided for 12,000. So but we paid this to GRE. We paid 15,000 to GRE. So which means that there will be a difference of what? 3,000. Okay, there will be a difference of 3,000. So this 3,000, we call it under provision. Under provision. All right. So we provided for this at the end of the year, and we hit it against our statement, and then we paid 15,000 to GRE. So which means that in our statement we have under provided. Now the standard IAS 12, that's income tax, says that when there is an under provision, you charge it as an additional tax in the subsequent year. All right. So now let's go back to our statement. So we were told that the balance of 6,300 is an under provision. Okay, so based on the position, it's an under provision. All right, so it will be added to current year's tax. Okay, so now let's do the workings. Let's do the workings quickly. So the workings will be, let's open an income tax account. So we'll have income tax account. Okay, so we have an income tax account. Okay, so we first hit it with our under provision of 6,300. Under provision of 6,300. All right, so 6,300. Okay, so that is the under provision. Okay, so now let's move on. So the next thing we were told was that the directors have estimated the provision for income tax. So this was supposed to be 2021. Okay, so to be 48,600. So which means that this year too there has been what? An estimation. So which is 48,000. So current tax provision. So we term it as what? Current tax provision, which is 48,600. I hope I'm right. 48,600. All right. So now the next thing is to check whether there's been any deferred income tax. Okay, so deferred tax liability or deferred tax asset. So now let's go back to the question. So we were told that at 30th September 2021, the current amount of Berlin Limited net asset were 39,000 in excess of their tax base. The income tax rate of Berlin Limited is 30%. Okay. So, when we see this, when there is a revaluation, or there is an increment in net asset in excess of the tax base, which means that there will be a future tax, because now the GRA, their tax base is lesser than ours. Our net asset is higher than the tax rate which GRA recognizes, which means that in the future there could be taxes, because that 39,000 would have been recognized by GRA. So if today GRA is not considering that amount, do not spend it. You need to make provision for it. So that is what we call provision for deferred tax. So when your net asset is higher than the tax base, or your current value is higher than, you need to make provision for any future tax payment. All right. So that future tax payment, we call it a deferred tax, a tax which has been deferred. You are not paying it now, you pay it in the future. So that is what we call deferred tax. All right. So when such transaction comes, you need to know the gain or the difference between the net asset and then the tax rate. So excess of net asset over the tax rate will result in a temporary difference, a taxable temporary difference. It is spelled out by IAS 12. So what we are going to do is that, so let's go into it. So let's leave this side alone, and then we do the deferred tax and see what happens. All right. So the deferred tax, so as at 30th September 2021, 30th September 2021. Okay, so we have it as 30% of the amount. So that will be the future tax you will be paying. So this is the actual difference, and then this is the tax rate. So which means that in the future you'll be liable to a 30% tax on this difference, but for now you are not liable. The standard says that make provision for it. Is that okay? So we find 30% of 39,000. Okay, we find 30% of 39,000. Right. So we say 30%. All right. So 30% of what? 39,000. Then we have 11,700. So that is as at the end of the year. All right. So now let's go back into our statements, and let's see what we have there. Additional information, IV. So IV, we have the current tax attached to it. Let's see whether we have another IV. So another IV is here. So let's check. Another IV is here. Another IV is here. All right. So this IV here is another deferred tax. It's another deferred tax. So now the question is, what does this deferred tax represent? So what does it represent? Can anyone tell us? We have a deferred tax in our statement. What can we term that deferred tax to? If we are familiar with it, what can we term it as? Okay, so we will term this as the deferred tax liability at the beginning, okay, or at start. So that will be let's see the start of the year. The start of the year is 1st October. So 1st October 2021. Alright. 1st October 2021. 1st October 2021. Okay. So So we have it here. So 1st October 2021. And then the amount is 16,200. So 16,200. Right. So now the question is, and I would like someone to answer that. So the beginning of the deferred tax is 16,200, but the end it is
Hello,
now,
friends.
yes.
Please, I was thinking, I don't know if the date has any effect or something, but I thought September comes before October.
Okay,
Or it's
yes, sorry. So this should be 2020. Sorry. Okay. So this should be 2020.
oh okay.
Thank you for that notice. All right.
Yeah.
So
Yeah.
the question should have been clear, but there's a whole lot of ambiguity in the question. But a properly structured question should have had a date attached to the deferred tax, signifying that is the beginning. Is that okay? All right, and thank you for that notice. All right, so that will be the astats. All right, that will be the astats. So 1st October 2020. All right, so thank you for that. So now comparing the two. So the first October 2020, that's the beginning. We were having 16,200, and then at the end of the year we had 11,700. So what is happening? Has there been an increase or a decrease?
An increase.
There's been an increase
Yes.
or a decrease. So
A decrease.
A decrease.
A decrease rather,
Okay,
yeah.
thank you very much. So decrease. So a decrease in deferred tax. Right. Deferred tax. Right. So a decrease in deferred tax. And the decrease is this minus this. So the standard says that. So you see everything is being referred to with regarding the standard. So no one is saying it. It's the standard that is saying. So the standard says that whenever there is a decrease in deferred tax liability, it should reduce our current tax expense. So you may want to write that. So a decrease in deferred tax liability must reduce our current tax expense, and then an increase.
Yes.
Are you okay now? All right.
Yeah. I'm not saying anything like.
Okay. I think you've not muted, and that's quite interrupt. Okay. Thank you very much. Okay. So can we move on now? All right. So as I was saying, a decrease in deferred tax would reduce our tax expense. So it will be a deductible in our tax expense account. But when there is an increase will be an addition to our current tax. So since we have a decrease in deferred tax, it will be a deduction. All right. So it will be a deduction. So decrease in deferred tax. Okay, to be a deduction of what? 4,500. So there will be a decrease. 4,500. Right. So 4,500. Right. Since it's a decrease, it should reduce our tax expense. But if it was to be an increase, it would have also increased our tax expense. So which means that a tax expense has a component of 1, under or over provision. It has a component of current tax provision, and also movement in deferred tax. So all these are spelled out in IAS 12, accounting for income tax. So now we find the sum of it. Okay, so we find the sum of it. So the sum of it is 50,400. So that would be the current tax, so tax expense for the year. That would be our tax expense for the year. Any question? Any question?
Hello, Prince.
Yeah.
Hey, sorry. Is it Prince? Sorry.
It's Prince.
So please, you mentioned that a tax expense has two components. A decrease in the deferred tax liability could be an increase or a decrease.
Okay.
Or you mentioned one
Then I mentioned the current tax provision. So 3. So the first one is the under or over provision. Then the next one is the current tax provision. And then the next one is the movement in deferred tax. So this is the movement we did down here. So we did it here.
Okay.
The movement. So this is the movement. So the movement, when we check the movement, there's been a decrease, and that decrease is a deduction. That is what we've done here. That decrease is what? A deduction. Right.
Okay.
That's what we have here. So these are the components of a tax expense. So a tax expense has under or over provision. It has a current tax provision, and then it has movement in deferred tax. So 3.
Thank you.
Very good. Okay, I hope it's well understood. All right. Okay. Any other questions before we move on to the next one? Any other questions before we move on to the next one? And I hope we are jotting all additional information, right? So we compile all of them and then work on the financial statement. All right. Any further question? No further question. Okay, let's move on.
Yeah.
All right. Okay. So we are moving on to the next additional information. And I want us to have a fresh page. Okay. Alright. So can we have someone take us to the last additional information? That's additional information V. Additional information V. The first paragraph. It has 2 paragraphs. So let's do the first paragraph, and then we'll do the next paragraph.
Okay, non-current assets. The freehold property has a land element of 39,000 Ghana cedis. The building element is being depreciated on the straight line basis. Plants and equipment is depreciated at 40% per annum using the reducing balance method. Berlin Limited brand in the trial balance relates to a product line that received bad publicity during the year, which led to falling sales revenues.
All right, thank you very much. Okay, so let's do with the first paragraph, which deals with PPE. So anytime you are preparing a full financial statement, PPE is treated in a schedule, unless the PPE is just one item. Okay, so this will lead us to visit IAS 16. So that's what deals with accounting for property, plant, and equipment. So we have here our PPE schedule. We have here our PPE schedule. Okay, so we will have the asset name as heading. So with the freehold, it's in 2 components. So we have a land and then a building. So a land and then we have building elements. Okay, so we have both in our statement. So we have building and then land, and then the next PPE will be the plant and equipment. The next PPE will be the plant and equipment. So plant and equipment. All right, so let's just limit it to that. and then okay, we have this, and then we have the balance. Okay, so we have the balance brought forward. So this will be the balance brought forward. That's the cost or the current value of the item. Right. So all right. So we were told that the freehold property has a land component which is 39,000. So let's report the land component as a balance before. That will be 39,000. And then we have the building component. So let's look at the total value of the building or the freehold item. So the freehold item is 219,000. Okay, 219,000. So this one should have been at the start of what, 2020. That's the beginning of the year, but that one they made a mistake with the date, so no problem with that. All right, so 219, so that would be 219 minus 39. Is that okay? So we have 219,000 minus 39,000. So we are going to get 180. So that is how it is done. So when you are giving a freehold item that has two components, land and building, you split it and you depreciate one differently from the other. Is that okay? Now let's move on to the equipment. So the equipment, the balance brought forward at start is also 126,600. Okay. So 126,600. Okay. So the next thing we need to do is we check whether there is any addition, that's acquisition. So let's term it as acquisition. Okay. So there was no acquisition. All right. So we move straight forward. Since there is no acquisition, we just put 0 there. 0, 0. Alright, and then we move on. So it will just be the summation of all this. Okay. So the balance will still be the same. Alright, and then we take out any accumulated depreciation. Right, any accumulated depreciation. So the accumulated depreciation, you'll get it from the question. And then, so let's start with the first one. So the first one is the freehold property. So the freehold property, what we need to know is that land is a non-depreciable item, which we already know. Land doesn't depreciate. Yes, land doesn't depreciate. It rather appreciates in value. So that real part of land is also applied in IFRS. So the standard also doesn't depreciate land, but we rather depreciate any item other than land. So we depreciate the building. So the accumulated depreciation relating to the property will be for the building. So the building's depreciation will be the 24,000. That will be the accumulated depreciation, which is 24,000. So we less that. Okay, so let's go there. So we'll have 24,000. So 24,000. So which means land will not have any of it. And so let's check whether plant and machinery also has some. So plant and machinery also has accumulated depreciation of 59,100. So 59,100. Okay, so we find the difference. So this minus this, so we get 156,000. Okay, so this is now the current value as at the end of the year. Okay, so now we calculate the current year depreciation. Calculate the current year's depreciation. Okay, calculate current year's depreciation. So current depreciation. Okay, so for the building in our additional information, we weren't told the specific number of years, but normally land their building, the lifespan is 10 years. So assuming 10 years for the building, since it's on straight line method, so 180,000 divided by 10 will be 18,000. So the depreciation will be 18,000. Land doesn't depreciate, so it's still 0. And then we were told, so let's visit it again, the plant and equipment. So we were told that plant and equipment is depreciated at what? 40% per annum, using what? The reducing balance method. Reducing balance method means that the rate will be applied on the current value, not the cost. Is that okay? Because if you check here, for the building, the depreciation was applied on the cost, but here the depreciation rate will be applied on the current value as at the year end before you charge your depreciation, the actual current value. Okay, so we charge 40%, so that will be equal to 40% on the current value. So that's how reducing balance it. Whatever is reduced to, you calculate on the current reduced amount, and then you move on. So this will be it. Then so we will have 27,000 as the current year depreciation. Okay, that will be the current year's depreciation. Okay, current year's depreciation. So now let's look for the current value for the year end. So that will be 30th September 2021, the reporting year. Okay, so we have this minus this, we have this. Okay, all right. Okay, so now what we need to do now is that let's know our total depreciation. So our total depreciation will be this plus this. That's our current year's total depreciation. That will be 45,000. And then the PPE value that will be reporting in our statement of financial position will be this plus this plus this. Then we have this 217,500. So this will be what will be reported in our statement at the PPE figure, and then this will be the depreciation that will charge to profit or loss. Is that okay? That's 45,000. Okay. So now, can we move on? Any questions so far on the depreciation? Any question? Let me take 2 or 3 questions. So we move on before we move on. Madam Rodlin, any question? Madam Millicent, any question?
Oh, please, I'm okay.
Oh, you're okay. All right. Okay. All right. Okay. So, Madam Millicent, do you have any question? I think your hand is still up. Any question?
No, please. Thank
You don't have
you.
any question? All right. Okay. Okay. So, can we move on? Okay. So, the next thing we were told is regarding the brand, but it's so unfortunate we've not done intangible asset, but I'll speak a little about it because even this is regarding impairment, IAS 36. So let's look at it. Okay, so can I have you read, Madam Ridlin, can you read the second paragraph of
Okay.
No.
An impairment review was conducted on 1st April 2021, which concluded that, based on estimated future sales, the brand had a value in use of 36,000 and a remaining life of only 3 years. However, on the same date as the impairment review, Berlin Limited received an offer to purchase the brand for 45,000. Prior to the impairment review, it was being depreciated using the straight line method over a 10-year life. No depreciation or amortization has yet been charged on any non-current asset for the year ended 30th September 2021. Depreciation, amortization, and impairment charges are all charged to cost of sales.
Okay. Thank you very much.
You're
So,
welcome.
with the little we have done in IAS 36 and 38, even though we'll do it subsequently, let's borrow that and let's tackle this question. Okay. All right. So, we were told that. So first and foremost, brand is an intangible asset, and then at regular interval we test for impairment. Okay, and then we were told that the value in use is 36,000, and then the fair value of the asset is 45,000. Okay. So this information will help us to identify our recoverable value. This will help us in identifying our recoverable value. And then from there, we'll compare it with the current value. Comparing with the current value, then we'll get our impairment. Is that okay? But we were told that during the year there hasn't been any depreciation and amortization. So the amortization part is relating to the brand. Okay. And now let's check. Date is very important when you are depreciating an asset. So we realize that the impairment testing came to bear from 1st April. Okay, or at 1st April. So which means that from last year 2020, from October 1st to April, so October, November, December, January, February, March, April. So let me check the start of the year. The start of the year is October, right? So October. Okay. So 1st October. So 1st October, November, December, January, February, March. So April will not be included because April is 1st. So it's 6 months. So which means that we were in the year 6 months before we realized that we need our brand is being impaired. So which means that the first 6 months we weren't impairing, or we hadn't conducted any test, but the test happened on 1st 2021. So the first 6 months will also have its effect in the financial statement, and then the period after the 6 months will also be taken care of. So that is why this statement becomes very important. This statement, amortization has not yet been charged on any non-current asset for the year ended. Okay, so the first 6 months amortization must be charged regarding the brand, and then the next 6 months after impairment will also be charged. Okay, so now let's run into it. So let's now look at the cost of our brand, or the value. So 2017. Okay, so 2017, this is it. Okay, so that's the cost as at 2017. So that's 90,000 2017, and then we are now reporting for 2021. So 2017, 2018, 19, 20, 21. So that will be 4 years, but it's going to be 3 years 6 months. That's ending 1st April. So it's going to be 3 years, because from 2017 to 2021 is 4 years. But since we conducted the impairment test on 1st April, which is half of the last year. It's going to be 3 years 6 months, so 3.5 years. Is that okay? So now let's go into the calculation. So let's note the cost of 90,000. So now let's go brand. So let's have another area, working area. Okay. So we have here brand. We have here brand. We have here brand. So the brand has a cost. So the cost is what? The cost from 2017 is what? 90,000, right? 90,000. Okay. So now the entity has charged depreciation for 3.5 years, ending 31st March. So accumulated, you have to know your accumulated depreciation, because we want to estimate the current value, okay, as at 1st April 2021. We want to know the current value, so we need to know the accumulated depreciation as at 30th March 2021, so that we will know the current value that we will be using when we are conducting the impairment. Okay, so now the issue is that we are depreciating the assets on straight line method, and then we were told that it is what, 10 years. So now let's go back to the question. 10 years useful life. Okay, so prior to impairment review, it was being depreciated using the straight line method. Okay, so let's check if there was any accumulated amortization. Okay, so we have it here. Okay, so this is assets 1st October 2020. So this is exactly 3 years, which means that after 1st October there hasn't been any amortization that has been calculated. Okay, so now let's get down. Okay, so now let's change this date to 1st October, since we already have that. If we were not having it, we would have calculated it. So 1st October, so that we know. So this will be exactly 3 years. This will be exactly 3 years. This will be exactly 3 years. So let me put it in bracket. This will be exactly 3 years. Okay. And then we have it as 27,000. So which means that this one will be current value as at 1st October. And that is the start of our accounting year. Alright, that's the start of our accounting year. Okay, so let's move on. Okay, that will be the start of our accounting year. Okay. Alright, so let's find the current value. So that's 90 minus 27. So we have 63,000. Okay, and then so now let's find depreciation from 1st October. So now we need to find depreciation from 1st October. Okay, from 1st October to 1st October 2020 to 1st April 2021. That is 6 months. Okay, that one is 6 months. So 6 months. 6 months. Okay, that one is 6 months. So that one is 6 months. Okay, so So depreciation. Let me
Prince, are we amortizing or depreciating?
come again. Okay,
Please, are we
amortizing.
amortizing?
We are familiar with the depreciation. That's why I'm calling it okay. But with
Okay.
brand, we amortize. Okay, thank you very much. Amortization. All right. So we amortize. Okay. So up to this point, the first 3 years we were given the accumulated depreciation. So that is what we have less. So now we've gotten the brand carrying value as at the start of the proper accounting year. But we were having the brand until 1st April, which we were told the brand has been tested for impairment 1st April 2021. So according to the standard, wherever you ended when the impairment test was conducted, you need to know the carrying value as at that time. Okay, so now let's check something here. The brand is 10 years. Okay, so if the brand is 10 years, which means every year will be 9,000, isn't it? Every year will be 9,000. So half a year is 4,500. So which means for the 6 months it will be what? 50% of this, which is what? 4,500. So 4,500 will be the depreciation for the 6 months. I hope it makes sense. Okay, so it's for 10 years. The brand is for 10 years. Okay, the brand is for 10 years. So which means every year is 9,000. Okay, and then the first 3 years will be what? 27,000. So the first 6 months when we started the year will be what? Half of this, which is what? 45,000. So if we less it from it, so we know the carrying value as at 1st April. As at 1st April 2021, when we were conducting the test. Okay, so that will be this minus this, then we'll get this. We are going to get 58,500. We're going to get 58,500. Okay, all right. I hope that calculation was very simple. I deliberately broke it down for us to get.
Please, I didn't get it all.
Okay, all right. So where didn't you get? Kindly notify me so I brushed through.
So the cost was 90,000, and then we used the straight line method to amortize it by 10 years. So we had 9,000.
Okay.
And then the 27 represented
The accumulated depreciation from
accumulated
2017
depreciation.
to 2020.
Okay.
Before we started the fresh year. No, the fresh year starts from 1st October.
Okay.
So we needed our carrying value before we start the fresh year. So we less the 3 years accumulated depreciation from it.
Okay. 3 years. So 9,000, 9,000, 9,000.
3
Or
years. Yes. 27,000.
okay,
we
okay. To
had-
get a 63,000.
Yes, so we less it from the 90,000 and then we had 63,000. Is it clear?
Yes. And then the 45,000. How we
Very
arrived at
good. The
that?
4,500.
4,500.
Very good. So the actual accounting year is 1st October. 1st October. Okay, it's 1st October 2020 to 30th September 2021. But within the year, mid-year, 6 months, we tested for impairment. The standard says that the moment you test for impairment, calculate the carrying value as at the date you tested for impairment. Okay, so as a matter of fact, we should have just added this to this and then less it from 90,000 so that we'll get 58,500. But I want to let us know the breakdowns of it. So the breakdown is that the accumulated depreciation, we have accumulated depreciation of 3 years, so we need to less it from it. Then we'll get the new current value as at the start of the fresh year, which is 63,000. So now the ensuing year which we are working, we need to amortize the brand. And since we need to amortize the brand, we should have amortized it for full 1 year. But we were told that the impairment testing started on 1st April. Okay. And then calculating the month from 1st October to 1st April is 6 months. And 6 months is half a year. So if every year you are amortizing 9,000, from 1st October to 1st April should be half of 9,000, which will give you 4,500. So that will be the amortization for half a year, and then you less it. So if you less it from the current value as at 1st October 2020, you should get the current value as at 1st April. That's where the first 6 months ended. I hope it makes sense.
Yes.
Very good. Any further question? Any further question before we move on?
Yeah. Right, please. My network was messing up, so with the I think the accumulate. Yes.
Okay.
Yes. So I'm kind of lost a bit.
Okay. All right. So now, the standard says that the moment you test for impairment, you should know the current value of the asset as at that date. Okay. So having that in mind, we had a brand from 2017, 1st October, and then from 2017 this year, from 2017 to 1st April 2021 is 3 years, 6 months. So these 3 years, so you see we have 3 years here, and then we have 6 months here. So the standard says that you should know the current value, which is as at the date you tested for impairment. So the date you tested for impairment is 1st April 2021. So we are looking for the current value as at 2021 1st April. But the component of the 3 years is that, of the 3 years 6 months, is that the first 3 years has already been exhausted, and its related accumulated depreciation is 27,000. Okay, which we were given in our statement. So it is here. Okay, which we were giving. This is 27,000. All right, we're giving that. Okay, so now moving forward, it ended on the date with which we were starting a new year, and then the new year is starting from 1st October. So we less the 27,000 from 90,000, and then we had the current value as at the start of the new year, and that's the current year with which we are preparing our statement. Okay, so and now from the start of the new year, which is 1st October, to the date of impairment test is 6 months, and the standard says that you need to know your current value before the start of the impairment testing, and then between that month is 6 months. Okay, so we said that the brand is for 10 years, each year is 9,000. So for 6 months it's going to be half of 9,000, which is going to be what, 4,500. So if you know the current value as at the start of the new year, lessen the 6 months amortization amount, it should give you the current value as at after the first 6 months, which is now 58,500. I hope that is clear. I hope that is clear. Is it clearer now?
Yes, please.
Okay, very good.
And also, yes, please, I want to confirm this. I learned that the intangible assets,
Okay.
we don't really use financing. Is it depreciation or
Yes,
something,
yes,
something?
no depreciation.
But it's amortization. I
Amortization.
just want to confirm it.
Yes, 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 that is it. That. Thank you very much.
For intangible
Yes, for
assets.
intangible. Yes, we use amortization.
Okay.
Yes, because as a matter of fact, intangible, you know, they are non-touchable items, and accounting has given it value, so you can't see it even for you to depreciate it. So that's why they gave it a name, amortize, just as we use for financial instruments. Things that are non-touchable, we use the amortization. But in substance, they are just the same, just that their names are different. Thank you very much for that. Can we move on? Okay. So we now have the carrying value. Okay. We have the carrying value. We have the carrying value. Okay. So let's touch a bit of impairment. Okay, before we move on. Impairment will be a major something I would treat on its own, but let's make some touches on it before we move on. So impairment, the idea about impairment is that as an entity, you shouldn't hold an asset at a value which is more than what it will be priced at the market. For instance, you have a car, and then you have valued the car at 500,000 Ghana cedis in your books. But if you go to a car market and then you compare your value with it, the actual value of your car will be sold for at 350,000 Ghana cedis. So that is why there is a need for impairment testing. So you compare your value, your book value, to the market value. So the standard is preventing us from holding our assets more than the value at the market. So if the value in your book is more than the value at the market, which means that your asset has been impaired. Your asset has lost value with the difference in between your value and then the market value. So that is what IAS 36 is all about. The head and tail of the standard is saying that do not hold your asset more than what it will be bought at the market. Else, you always run at a loss, because you are holding an asset 500,000, but Toyota car market will buy it for 350. All you are thinking is you were expecting a proceed of 500,000, but the asset to be bought for 350. So the standard is saying no, do not hold your asset at that 500. You should scale it down to the one at the market. That is all the standard is saying. But the opposite is another thing else. If you are holding an asset, but at the market it will be priced higher, the standard says do nothing. Don't do anything. Just leave it like that. For instance, the asset is 500,000, but when you go to the market, it is 800,000. The standard is saying that you are safe, because today when you want to sell it, it will be sold or bought from you at a higher price. So don't do anything. You should only do something when you sell it. So that is when there will be profit on disposal, which will be dealt with by IAS 16, disposal of PPE. And IAS 16 will not come to play, impairment will not come to play. Okay, so in conclusion, if you shouldn't hold an asset at a value which is more than what is at the market. And also, if the value at the market is more than what you have, do nothing, because your asset has not been paid, because the value at the market is high. But if the value at the market is low, and the value in your book is high, if you go to the market, you run a loss. So the standard is saying that recognize that loss now. That's what we call impairment loss. Okay, so having established that, in testing for impairment, we have what we call the carrying value. We have what we call the carrying value. We have what we call the recoverable value. Recoverable value. So recoverable value, as the word explains itself, recoverable. What value will your asset be recovered? And then the recoverable value has two components. Okay, it has two components. The first component is value in use. I'm sure you're familiar with it. Value in use. And then the next one is your fair value less cost to sell. Okay, so now the recoverable value comes in two folds. The first one is value in use. When we say value in use, what is the value you'll be generating from the asset if you continue to use the asset? That's the value in use. And then the fair value less cost to sell, it explains itself. What's the fair value at the market and what's the cost of selling it? So when you sell something, you less the cost of selling it so that you get the actual value. And then the value in use is the benefit, the future benefit you generate from using the asset. So that one has time value in it, time value of money in it, because it's a future benefit, so you discount it to the present. So now we are just having a summary of it. I think hopefully tomorrow we'll delve more into it, but we are doing it for the purpose of the brand. Okay, all right. And then so let's move on. So the next thing is that the value in use and then the fair value less cost to sell. The standard says that you should pick the higher of the two, between the two. So pick the higher of the two. Okay, pick the higher of the two. So now let's go back to our question. Okay, so our question is saying that we have a brand. We have a brand of 36,000. That's the value in use. So we were told that the brand had a value in use of 36,000. Okay, so we have a brand of 36,000. So the value in use is 36,000. 36,000, right? And then we're told that Berlin Limited received an offer to purchase the brand for 45,000. So which means there was an offer to purchase the brand at what? 45,000. Okay. Okay. So what do we think would be our recoverable value? So picking the higher of the two. What would be our recoverable?
45,000.
It would definitely be the 45,000, right? Because that's the highest, or that's higher. So our recoverable value is going to be 45,000. Okay, very good. Our recoverable value is going to be 45,000. Our recoverable value is going to be 45,000. Okay, so since our recoverable value is 45,000, so now we have our current value as 58,500, so equal to 58,500, and then we have the recoverable value as what? 45,000. Okay, so our recoverable value is 45,000. All right, so now comparing these two, okay, this is the current value. Borrowing the idea we shared, so we are saying that impairment, okay, this is the value we have in our book, okay, but at the market it is 45,000, and the standard is saying that you shouldn't hold your value or the value of your asset more than what you can get at the market. So if that is the case, you should scale it down to what it will be at the market, because the market one is the smallest. Okay. So impairment occurs when the current value is greater than the recoverable value. So it's equal to impairment. There will be impairment. Okay. There will be impairment when the current value is greater than the recoverable value. So in other words, if it's greater, then the difference, so I'm putting a minus, okay, the difference should give you the impairment. So now the difference between the current value, if only the current value is higher, and then this will give us impairment. So impairment value is what? 13,500. 13,500. Any question? Any question regarding that?
Well understood.
Come again?
I'm saying it's okay.
Okay. All right. Thank you very much. So now, the recoverable value is the value. So the recoverable value is a value as at 1st April 2021. Okay. So we need to know the amortization for the remaining 6 months. So that is why I said this part is very important, as they told us. So they said amortization has not been charged on any non-current asset for the year ended. Was that okay? And then we did for the first 6 months. So this is the first 6 months. So the first 6 months we had 4,500. Okay. So the remaining 6 months, now the value of the asset is now 45,000. The value of the asset is now 45,000. So which means that there will be further 6 months amortization. Okay, so the further 6 months amortization is going to be so the remaining 6 months amortization. So the remaining 6 months amortization. Okay, so we need to amortize meaning 6 months. 6 months. So remaining 6 months. Okay, then the remaining 6 months will be charged on this value. So this is now our current value. So this will be the value as at 1st April 2021, sorry. So the remaining 6 months, okay, is from April 1st to September 30th, which is 6 months. So we can calculate. So April, May, June, July, August, September, 6 months. So to September, okay, that is 6 months. Okay, so that is 6 months. So remaining 6 months. All right. So the remaining 6 months. So which means that, and we were told that the remaining useful life is what? 3 years. And a remaining useful life of what? 3 years. The remaining useful life is 3 years. Okay. So what we'll do is that we will just divide it by 3 and multiply by half. Okay. So if it's 3 years and then it's 14,000, which means that every year will be what? 15,000. All right, that's 45,000 divided by 3, so it's going to be 15,000. Okay, so it's going to be this, so let's see, equal to this, okay, divided by 3. All right, so let's put it in bracket, divided by 3. Okay, 3 years times half, because half a year, so half is what? 0.5. Half is 0.5, so we'll get 7,500. So that will be the amortization. So the total amortization for the full year, so total amortization full year, the full year during the year, okay, will be the first 6 months and then the remaining 6 months, right? So it will be the first 6 months and then the remaining 6 months. All right, so the first 6 months, so now let's calculate it. So equal to, so the first 6 months, so the first 6 months is here. Where is it? The first 6 months amortization value plus the second 6 months. The second 6 months, which is this 7,500. So the actual amortization will be 12,000. I hope it's clear. Okay. So I think we are done with all the adjustments. We are done with all the adjustments. We are done with all the adjustments. Okay. So the next thing we'll be doing is now prepare our income statement. Okay, so now let's look at how the income statement is going to look. So let's prepare our income statement. Let's prepare our income statement. So statement of income. Statement of income, right? So statement of profit and loss. Statement of profit and loss for 2021. Okay, so we have our city sign. Then we have, so we start with the revenue. Okay, so we start with the revenue. So this should be the revenue. Okay, so we start with the revenue. So our revenue, and then our revenue figure will be the 1 million. Remember the calculation we did? Okay, this is Excel, so I'll just be taking the figures. So it's equal to this. Let's go up. Let's go top. Where is my figure? Oh, I've deleted it. Oh, okay, they are gone. Okay, this is it. Alright, so this is the revenue figure. Alright, the actual revenue we had. So we took out the item for which 30 days return. Okay, so that will be our revenue. We place it there. And now our cost of sales. We were told that we'll be adding depreciation, amortization, and then impairment. Okay, so that we have to know our actual cost of sales. Okay, so let's put here cost of sales. Let's do the adjustment. Okay, cost of sales. Okay, so we have it here, and then cost of sales, the actual balance in the statement we have here is 740,400. 740,400. All right. So we have the balance 740,400. All right. And then we have, so we will add the amortization. Remember the amortization, what you have is what? 12,000. What you have is 12,000. And then you have impairment. The impairment to, so we are not picking the words from anywhere. We have it here. Okay. So this is the impairment, 13,500. This is the amortization. Okay. So let's go down. So we have it here. Impairment 13,500. And then let's go to PPE. PPE 2, we have the asset. PPE 2, we are going for the depreciation. Okay, so this is the depreciation. The depreciation is 45,000. The depreciation is also 45,000. So if you have written it, you should be able to locate where exactly it is. All right. So the depreciation will also be added to cost of sales. Depreciation 45,000. Okay. So now the summation of this should give us the cost of sales. Right. So our cost of sales. So our cost of sales.
Prince,
Yes.
please, was it stated in the question we should include all this as part of cost of sales?
Yes. Let me locate it for you. So they said depreciation. Can you see where I've highlighted?
Yes, please.
Okay, depreciation, amortization, and then impairment charges are all charged to cost of sales. So you add it up to cost of sales because it's a deduction, and cost of sales is also a deduction. So when you add it up and then you less it.
So meaning that if you have all these workings wrong, it is going to affect the cost of sales.
Perfectly.
And eventually it will affect everything in the P&L.
Yes. But financial reporting, it's all about ticks.
Entries, okay.
Entries. So eventually you'll be getting some ticks. So and also it also reminds us that we should be very critical at what we are computing, else we'll be getting figures wrong. Can we now move on?
Yes,
Okay,
please.
very good. So now the cost of sales will be this. We add all these. So sum of what? All these three. Okay, we have this 8109. All right, and then let's underline it nicely, and then we're going to have. Okay. So now, okay, let's continue. So that's the cost of sales. So our gross profit is the difference. So our gross profit will be 305,100. Okay, and then we move on to our distribution cost. So everything has been arranged for us. We just pick them. Okay. So from cost of sales, we go to what? Distribution cost. There wasn't any adjustment, so we won't do anything with it. So we just take the figure 52,200. So this three costs 52,200. 52,200. So you should know we are lessing. Since it's a cost, so less. Let me put it there in case maybe we so the next thing is our admin expense. Remember, we adjusted our admin expense. We took out the dividend from it. Okay, took out the dividend. Okay, we should have the calculation here. So this is it. So the admin expense, the equity dividend, took it out of it, which is this. So this, and this. So when we took it from the actual admin expense, we had 115,500. Okay, so let's go 115,500. All right. So 115,500. So admin will give us 115,500. So 115,500. So that will be admin. So let's admin. Okay. So the next thing will be our loan interest. Remember the loan interest, we said that we'll be adding the 1,400 and something. Okay, let me see if we have it there. Okay. Alright. So let's go to that part. I want us to see that part well. Okay, so this is it. So the loan, it was already 3,000. Okay, which is this. And we said that we'll gross it. So it will be 4,430 instead of 3,000. So 4,430. Okay. Alright. 4,430. Alright. So loan interest. So that one too is less. Loan interest. So 4,430. Then the next thing will be the next item on the list. So the next item on the list is investment income. Right? Investment income. Normally, such incomes are put together as what? Other income, and also profit on sale of investment. We put it together as profit, other income. But let's just put it on the face. Okay, it's nothing. Profit from disposal. Profit from disposal. Profit from disposal. So that is 6,600. Okay. So we have the first one to be 3,900 and then 6,300. Okay, am I right? Okay, let me check it again. 3,900 and then 6,600. Okay. And also, so now we add up. Okay. So we add it up, we underline it, and then so the gross profits, okay, minus this, minus this, minus this. Okay, so let's see everything clearly. Okay, and then this will be plus, so plus income plus another income. Okay, then we are getting 143,800. Okay, 143,800. Right. Okay, so that will be our profit before tax. Okay, profit before tax. All right, so 143,450. Okay, so can we move on? All right, let's keep going. So now our income tax, let's go and look for our income tax. Our income tax is what? 50,400. No doubt we have it here. Okay, so income tax, 50,000. So income tax will be less income tax of 50,400. So we get profit for the year. Profit for the year. Okay, so it's the difference. Okay, minus this, get 93,070. So that was very simple. That was quite simple. Okay. And then okay.
Prince,
Yes.
is the loan interest is the same as finance cost?
Finance course, very good, very good. So that's the name. But I don't want to make things quite technical, so I'm just using the exact figures. As I was saying, certain items must be grouped. Like for instance, this we need to put them together as other income, and should have even come before the gross profit. It should have even come before the expenses started, so that we add it to income and then get the total gross profit. But I just want to make things quite simpler, and then doing it as it has been arranged, just for simplicity. So thank you for that. So it's the same thing as finance. Okay. So the next thing will be our statement of changes in equity. Statement of changes in equity is very simple. Okay, very simple. All right. So you just take the items which you have, the same items you have. That's what you are going to use. That's the same thing you are going to use. Okay. So let me see it here. Let me merge this side. Okay, so we have our statement of changes in equity. It's very simple. Okay, so we have it. So the first thing to do is to check your statement to know your equity items. And in this statement, our equity items are the ordinary shares, the retained earning, and then our contingency reserve. Remember, the loan is what? A liability. Is it clear? All right. So let's move on. So we put it there. So ordinary share. So the ordinary share, let's term it as stated capital. Okay. Normally that's what we call it. Stated capital. And then we have here our retained earning. We have here our retained earning. Then the next one will be our contingency reserve. So conti reserve. Okay. All right. Then we will have the balances. Okay. So balances. So we just report everything you have here. This three. So this, and then this. As simple as that. Okay. So the first one will be 156,000. The next one will be 78180. Then the next one could be also. Then the next one will be 15,000. The next one will be 15,000. Okay. So now here, what we will do is that we adjust it. Okay. So now the next thing we report will be our profits. Okay. So we report our profits. Our profit is this figure. This. Yeah, they are sure. Alright. Then the next thing will be the equity. Remember that when we split the financial liability, the convertible, there is an equity component. So let's go and pick it. Let's go sharp. Okay, so this is it. So we have it here. There's an equity component. So this is the equity component. So this is the equity component. The equity component is this item. So we pick it. So we've picked it. Okay. So we place it there. So that will be the equity. So this side will be 0 and the other stuff. And then there was a dividend. So now let's go. The dividend will come under retained earning, because we take dividend out of what? Profit. So the dividend will be here. So let's go and pick that the dividend too. So the dividend is here. Let's go and pick that one too. So the dividend is here. So this is the dividend, 36,000. Okay, that one too, we put it there. So when we are done, now let's find the balances. Okay, the balances. So this plus this. Okay. Then we get this, right? 160, and then this plus this minus dividend. Then we get 135. Okay. And then this one will be the same thing. Alright. So now the total balance. Okay, we don't even need the total balance for anything because we'll be reporting it straight away. Alright. So this is what we call the statement of changes in equity. Simple. Okay, it's nothing of a big issue. Alright. So now let's move on to our statement of financial position. Another simpler thing. Alright. So that will tell whether you've done a good job or you didn't. Okay. So statement of financial position. Okay. So now we'll start with our PPE. Okay. We'll start with our PPE. Right. So we have here non-current assets. Okay. So the non-current assets, we have PPE, and then we prepared a PPE schedule. So let's go for the PPE. Okay. So the PPE, we are going for the PPE figure. So the PPE figure is here. So this is the PPE figure. Okay. We've gone for it. Alright. So we've gone for the PPE. So the next thing we'll go for is the brand. So the brand, so let's put our equal to sign there and let's go for the brand. So remember that the brand, the value was this. Okay, the value as at the impairment year was 45,000. Okay, and then we later charge impairment of what? 6 months. So we will take that 6 months because the 6 months was charged on the 45,000. So we take it out. So that will be this minus this. Let me check if that has been captured. Okay, we've not been able to get that. Okay, so even with that, let's just go by the manual way if we are not getting the automated one. Okay, so this minus this. Alright, so 45,000 minus 7,500. Alright, so we'll get 37,500. So we'll get 37,500 for the brand. So 37,500 for the brand. Okay, and then the next thing will be our next non-current asset.
Please,
Yes.
I want to recall that one note. The 45,000 minus
Could you please amplify? I'm not hearing you clearly.
45,000
Okay.
minus
Minus the remaining 6 months, because this fair value was the recoverable value as at 1st April, and after 1st April, anything behind 1st April has been dissolved. So after 1st April, we are having a cost of 45,000, and then impairment of what? 6 months, which is 7,500 up to the end. So that's the only thing. So we don't have any accumulated depreciation again because we've already less them from our books. We've taken them out. During impairment, everything is scrapped off. So you only recognize prospectively anything ahead of you. Anything behind you, you say no to it, it's gone. Is it clear? Can we move on? Okay, alright. Thank you very much. Okay. 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 So that's it. So the brand. So let's go inside and let's check another non-current asset. So the next non-current asset, you see everything is following. So freehold, plant, brand, accumulated depreciation. So the next thing will be the investment in equity instrument. It's at the debit side. Okay, this is a financial asset. All right. So we added investment in equity instrument. An equity instrument. Okay, so that one will be 79,500. 79,500. Okay.
So please, assuming the investment equity instrument is on the credit side, it will be what, a liability?
Yeah, liability. Very good. Very good.
At where? Non-current liability.
Yes. So if it is an investment in equity and then it's at the credit side, which means that we are the ones who have issued a share. So in that case, it will still have a credit balance, but there is no obligation. So we won't classify it as a liability. We rather classify it as equity and add it to stated capital. But if they tell us that it is a preference shares, it's a redeemable preference share, with that one it's a liability. Because there are several types of equity. Okay. And then there are ones that are redeemable and ones that are non-redeemable. So the non-redeemable ones, which means that they will be there for long, so that one, they are equity. But the ones that are redeemable, which means that we will have to pay back, that one is a liability. Okay, so when it's at the credit side, there must be further information regarding whether it's redeemable or non-redeemable. Then we know what to do.
At our level, I don't think they will
No,
bring that one up.
nothing.
Okay.
Anything that will come will be very precise and understandable.
Okay. Then Prince, one thing, please, with the depreciation that we worked on, the PPE,
Okay.
will it not reflect at the P&L?
Oh, the PL. Okay. That's the profit or loss, right?
Yes.
Remember, we were told we should add it to cost of sales.
Oh.
So let me take us back to that side.
Yeah.
We were told, okay, so we added it here. Okay, which is this? Okay, this is it. Remember, so this is our cost of sales. So we were told to add it to cost of sales. We were told to add it to cost of sales. So this is the depreciation. So we added it to cost of sales. Okay. And then we included it here and then we deducted straight away. Because depreciation itself, according to IAS 1, it doesn't have any place. So you could either be told to add to cost of sales or any relatable item, like maybe distribution. Maybe it's a motor van. So if depreciation should be under distribution because you use the motor van to distribute items. Or maybe you add it to admin expense because it's an office building. An office building is for administrative work. That's how it is. Okay. Let's move on. Okay. So the next thing we will do is our current assets. Okay. Current assets. Our current asset. So our current asset, we'll start with inventory. Okay. Inventory. Remember, your inventory at the end becomes an asset to you. Okay, and this is our inventory at the end. The inventory at the end is what? 114,000. 114,000. Okay. Alright. 114,000. So we go on to that. then our trade receivable. Our trade receivable. Our trade receivable. Okay. So this assets. So we are done with this one. Okay. This is it. Then our trade receivable 133,500. 133,500. 133,500. And then the next thing is bank. Okay, so we have bank of 24,000. 24,000. Okay, I think that's it. Okay, so let's find the total. Okay, so we are adding all these. Alright, and the sum of all these. Okay, then we get 606,000. Sorry. Alright. So the next thing we will do. So these are assets, non-current assets and non-current liability. So now let's go to the equity side. So we have our equity. Okay. Equity. Okay. The equity, we start with the stated capital. So let's go to the changes in equity. So we take our stated capital. Let's go and take. So this is it. Remember, stated capital balance is this. See, so we've taken it. The next thing will be our retained earning. The next thing will be our retained earning. Next thing will be our retained earning. Our retained earning is 1,352. Okay. And then our reserve, quantity reserve. Quantity reserve. Okay. $15,000. Okay. And then the next thing, so we can find the summation of this. Okay. And then the next thing will be our non-current liability. So non-current liability. Okay. Will be the loan, the convertible loan. Okay. Convertible loan. Okay. Then the convertible loan, that's the liability component at the end. Okay, so let's go for it. Okay. So the convertible loan, so the liability component. Okay. So it is here. So this is it. So after amortizing your carry down your closing balance. Okay, so this is the closing balance. Okay, because I was using some of the sheet, that's why the closing. So this is the closing balance. This is it. This is the closing balance. Okay, 56,081. Okay. So that's it. Then the next thing will be our current liabilities. So we have our payable, then we have the deferred tax, Then we have our current tax provision. Okay, and then we have the next thing we have will be the deferred income, as a result of selling the goods. The deferred income. So let me do it. 30 days return policy. Okay. All right. So the payable from the statement, we have our payable here, trade payable, which is 15020. 15020. Sorry. 154020. 154020. All right. And then we have our deferred tax. So the deferred tax will be the deferred tax at the end. So let's check the deferred tax we were having, the adjustment we made. Let's check. So deferred tax at the end. So the deferred tax at the end, which is what? 11,700. All right. Okay. 11,700. 11,700. All right. 11,700. Then the next thing will be current tax provision. The current tax provision has already been stated in our financial statement. The information we were given. The current tax provision. So let's check. We have it in the additional information. So current tax provision is what? 48,600. So that's the provision. It hasn't been paid, so it's also a liability. 48,600. Sorry. And then the deferred income, 24,000. We balance our account.
Wow.
Yeah. So now let me zoom it back so that we see what we've done. Okay. So we balance our account. So this is what we have. Let me zoom in a little bit. Okay. So our total assets and then total liabilities have agreed. So this is it. So this is the total assets and total liability, and then our total equity and then non-current liability. So they've agreed. So we balance it. We balance the account.
Hey. All under how many hours?
All under 3 hours.
Hey.